I've watched a lot of real estate gurus over the years, and the biggest injustice they all commit is telling people that real estate investing can work anywhere, including right in your own backyard. Sounds great, right? Well, I call BS. You're going to tell me that a 2-bedroom condo in my local area that sells for 400 grand is the same quality investment as a 3-bedroom house in the South that sells for 150,000? No, I don't think so. Now, the problem is that when most people think of buying a property that's 2,000 miles away, that sounds scary and super risky, right? What if something happens? How am I going to be able to handle any problems that arise when I'm so far away? Well, keep watching, because in this video, I'm going to list all the ways that investing remotely in affordable out-of-state markets is actually less risky and less scary than buying an expensive property in your local high-priced area. In fact, I'm convinced this is the lowest risk avenue to creating wealth transformation through real estate, and I'm going to show you why. Hey, I'm Jim Bevins, a 30-year engineering veteran who pivoted my retirement to real estate. And I bought 6 properties and counting in 3 different states that now cash flow thousands per month. I'm here to show you how I did it and how you can too. Okay, so let's talk about risk in real estate. The key to lowering risk is to go after lower prices in affordable markets. Once you do that, there's a domino effect. Lower prices just open up all these other factors that help reduce risk. So let's go over them all, okay? First off, when you buy with a lower price, it means you have a lower investment. That may seem obvious, but it's the most crucial part. I mean, that's where we start. If you're going to buy a $500,000 house, you've got to put 20% down. That's $100,000 you're investing. Whereas if I go into the South and I buy a $150,000 house, I'm putting down 30 grand. So just the fact that I'm risking less of my money is by definition a lower risk. So that's the first place to start. A lower investment means a lower risk. Now, the corollary to that is that when you are investing a lower amount, that means your investment capital can potentially buy more properties. And when you buy more properties, you are spreading out your risk. So if you have $100,000 to invest, instead of putting it in that one property in your local market, you could take that money and you could buy 3 properties in a much more affordable market. And that does 2 things. It triples your cash flow and spreads out your risk between 3 properties. And so now, not only are you investing, each investment is a lower risk, but your total risk is lowered because you spread it out among multiple properties. The third way that this strategy reduces risk is with a lower price point, you get cash flow. Your rent can cover the mortgage payment that is much lower. And with cash flow, you now have an asset that maintains itself. Yes, you can have short-term hiccups, you can have expenses, a tenant can move out, but the cash flow will replenish any expenses you have. And over the long term, any short-term hiccups are dwarfed by the long-term returns you're going to get from this property. Now, compare that to a property in your local area that's much more expensive, and chances are the best case is that you're breaking even. And I'm willing to bet once you factor in insurance, taxes, other expenses, I'm willing to bet that your breaking even is actually negative cash flow. And having to feed the meter like that every month, that is an incredibly risky and scary place to be. The fourth way that this investing strategy reduces risk is because we have cash flow, we can afford to pay a professional property manager to take care of the property for us. Now, I realize to some people this may seem like a higher risk. It feels like you're giving something up. You're giving up control. And I generally agree that if you have less control, it's more risk. But I know for me personally, knowing my strengths and weaknesses, which my strengths do not include taking care of properties or managing tenants or any of that, then I know that having a professional property manager in place, dealing with what they're best at, is a far less risky avenue for me. I acknowledge not everybody might view it that way. So let me quickly seg into reason number 5, why this is less risky, because when you have a professional property manager in place, you are now equipped to scale your portfolio to multiple properties, as many as you can buy with your capital, and you can do that with very low effort because the management is going to take care of it all. If you are self-managing properties, you are probably going to top out at 2, maybe 3 properties before you just have no more bandwidth. I mean, that becomes your second job, right? And so that's what a professional management does for you, is it lets you scale. And the key to success in real estate is scale. And part of that is because of the lower risk. Because think about it. If you've got, say, 5 properties and they each cash flow $300 a month, you've done 2 things simultaneously. First of all, you've multiplied your cash flow. You're not just getting $300 a month now, you're getting $1,500 a month. At the same time, you have distributed your risk. The chances of something bad happening to all 5 houses at the same time is extremely remote. Most of the time, if something happens, it's just going to happen to one of them. And you're going to have $1,500 from all your properties to pay for that one thing. Now, sometimes you might get 2 things that happen at the same time. Occasionally, very rarely, you might get 3. So you might still get little, hits here and there. Maybe. I'll tell you, in my case, with 6 houses, I have not put money into my accounts in months. I think it's been a couple years. There are times when I don't take money out, but, often I'm either taking money out every quarter or I'm standing pat and I'm just letting any expenses get replenished through cash flow. So that combination of more money and just spread out risk means that is a huge way that we reduce risk in our portfolio through investing remotely in affordable markets. Finally, the 6th way that this investing strategy reduces risk is that we are investing in areas that are much more landlord friendly. Okay, we are not dealing with restrictive landlord-tenant laws that give a tenant options to stay for months and months while they fight an eviction. In most of the states where these affordable markets are, the eviction process is no more than a 60-day process. In a couple of extreme cases, there's a couple of states where it's actually a 30-day process. Like literally, if you don't pay your rent by the 5th, you get a notice on the 15th, and then you go to court and you're out by the end of the month, and the sheriff is at your doorstep. So those are extreme cases, but 60 days is still a huge improvement. And the thing to keep in mind with real estate is that you get in the real estate game for any length of time, you are going to deal with bad tenants. The key is making those situations as least painful as possible, and just dealing with a little 30 to 60 day hiccup that is much, much more manageable and less risky than if a tenant stops paying and now you got to spend a months-long process to get them out, maybe even like a year-long. And I've heard really horrible horror stories in California about how long it can take to kick out a tenant, right? So that is another way that we are reducing our risk, because any short-term hiccups, we know that it's going to limit our loss, and that once we know that our losses are limited, then we know that cash flow can just replenish anything that we have to pay out. So those are all the ways that investing in out-of-state properties is actually less risky than buying expensive properties in your local area. So does that mean that investing remotely carries no risk at all? No, of course not. This is real estate. Stuff happens. Tenants move out. Things break. But the difference is that those are all short-term risks. They're of a much more short-term nature versus the long-term systemic risks that we take when we buy a local property, right? Those mortgage payments are always going to be really high. That cash flow is always going to be super thin, if not negative. So we are living with those risks for a long time. Whereas investing remotely, if a tenant moves out, something breaks, we pay for it out of our reserves, and then the cash flow replenishes it. Now, it still is important, though, that we factor in those short-term risks. And in fact, there are 2 ways that I recommend investors mitigate our risk when we get into the real estate game. And in fact, as soon as you get your very first property, I recommend that every investor does these 2 things to help lower our risk. The first thing you need to do, and I just mentioned that, is establish reserves. Reserves are crucial to succeeding in the real estate game. There are only two ways to lose in real estate. You either quit or you get knocked out of the game. If you can avoid both of those things, your real estate investment is going to be a winner. Just given enough time and resources, and it's going to be a winner. The real estate market has proven that, okay? Quit or get knocked out of the game. And what reserves enable is they keep you from getting knocked out of the game. My general rule of thumb is to keep 3 months mortgage payments for each property you own, and then add on top of that another lump sum amount of at least $5,000. If you can get up to $10,000, that's ideal. But have that $5,000 to $10,000 lump sum for about every 5 properties. You don't need it for every property, but chances are when you have 5 properties, if something big happens, then you have that funds there to do that big make ready or to repair that big item or something. So keeping those reserves handy is what will keep you in the game. Now, I recommend that those reserves, you actually keep them in the same checking account that your property manager is depositing your rents into. And so this way, when expenses come, you just pay it out of that same checking account. And then in subsequent months, the cash flow comes in, the rents come in, and the cash flow automatically replenishes those reserves. And this way, this helps smooth out what can sometimes be a bumpy ride. Like there's some expense, there's some window that costs $800 to replace that somebody broke. And so you get $800 less from your property manager. And now you pay your mortgage, and maybe you need to dip into your reserves a little bit to pay your mortgage because you didn't get as much money. But then the next month you get the full amount, and that that cash flow replenishes what you just spent. And this all happens in the background. It doesn't affect your personal economy at all. It doesn't affect your personal checking or savings or anything like that. So that's my first real important key, is establishing reserves, and more importantly, establishing the right mindset around the reserves. Like when you set those reserves aside, they're gone. You consider them spent. They belong to the properties, right? And now when stuff happens, then you just kind of let it slide off your back. And it's like, yep, that's real estate. But you know that you're still getting the future cash flow, the leverage depreciation, you're still getting principal pay down, you're still getting tax savings, you're getting all the benefits still. The second really big thing we can do to mitigate short-term risks and make any short-term hiccup much more manageable is scaling up our portfolio to multiple properties as fast as possible. I already talked a little earlier about how owning multiple properties does two things. It multiplies your cash flow and it spreads out your risk. And the combination of those two things just makes a huge difference in how much easier it is to manage rental properties. So just to illustrate what that can look like, let's kind of run through a few different examples. So let's say you own one property. You buy one turnkey property and it cash flows about $300 a month. And you're feeling good about yourself. You did it. Congratulations. But here's the thing. With $300, even the smallest expense will eat your cash flow. A moderate expense will eat up months of cash flow. You spend $1,000 to repair a furnace or something, then that's, a quarter of your year's income, right? So it's a very risky place to be. Now, I understand that getting into this game, it can be slow to start up. Some people all right, they have enough money for one down payment, but they're going to have to save up more to buy a second or third property. And, even if it's coming from RSUs or bonuses, it might be another year before you can buy a property. And that's okay. What I recommend when people are in that situation, that they stick with a turnkey provider that is really focused more on minimizing expenses, minimizing maintenance expenses, and does a really emphasizes getting quality tenants in. And there are turnkey providers like that. The downside is that some turnkey providers like that, they might not be focused as much on the cash flow. In other words, the process they use to keep that quality tenant there, they may charge a little bit lower market rents, for example. I know that's a philosophy of some property managers, is they're going to lower rents below normal market rates, and that's going to attract a lot of applicants And then they can really focus on, that gives them a better chance that there's some really good ones that will rise to the top. So that's just one example. But it is possible to get in the game and buy just one property and minimize that risk. But my point still stands. Continue to save up. Continue to buy more properties over time, even if it takes you another year to buy your second one and another year to buy your third. Because what's going to happen is, kind of moving along, let's look at what it looks like when you have 3 properties. When you have 3 properties, let's say they all cash flow $300 a month, then now you've got $900 a month. And now you're able to pay for moderate expenses. That $1,000 furnace repair, that $800 window, that comes out of the cash flow for that month, and you don't even feel the impact. It doesn't even dip into your reserves that much, if at all. And even if you do dip into reserves, it won't take that long to replenish them. You'll probably replenish them by the next month in most cases. And then you're off, and you're continuing to collect positive cash flow. So the next tier is when you get to like 5 or 6 properties. And by this time, you probably built that up over time. And so the first properties you bought may even have a rent increase or 2 in them. And so you're probably looking at total cash flow in the $1,500 to $2,000 per month range after fixed expenses. With that amount, now the portfolio really starts to become self-sustaining. Now you are able to handle most, moderate to even high expenses. Just to give an example, my own portfolio is 6 properties, and it's been a couple years now that I've owned most of these, and so they've all had some rent increases. When I got them, they first cash flowed about $1,800 a month, but now there have been some rent increases, and my mortgages stay fixed, and so now they cash flow about $2,500 a month. Well, just several months ago, I had HVAC that needed to be replaced in one of my properties. Needed to replace the whole thing. It cost $2,700. This was a property that I bought on the MLS, so it wasn't a turnkey. So that's the downside to buying on the MLS. If it was a turnkey, the furnace would have been fine. But I needed to pay $2,700, and it just came almost entirely out of 1 month's cash flow. The other properties just paid for it. And so that's what I mean when I say self-sustaining. The portfolio starts becoming self-sustaining and taking care of itself. And when that happens, then that's when you've unlocked the real power of real estate. The next milestone, the one that's kind of like the real game changer, is when you get up to 10 properties. When you're at 10 properties, by that time, just not only through the cash flow of year 1, but just because of the ones that you bought early on in your first year or two, you probably had multiple rent increases. And you're probably looking at total cash flow of $4,000 to $5,000 per month after fixed expenses. It's at this point where it's not only self-sustaining, it becomes very difficult to not cash flow. Right? I mean, you have to work really hard to come up with expenses that total $4,000 to $5,000 most months. And this is when you really start having options. This is when you start thinking, could I harvest equity to start paying off 1 or 2 houses so that they are free and clear? And so I could be getting $1,000 or $1,500 per month from each property. And so questions like that you can start to ponder. You can start to think, $4,000 to $5,000 a month. Could I maybe retire my spouse? Right? So those are when options really open up. Or you can just keep going, because if you're making $5,000 a month in cash flow, think about it. That is $60,000 per year. That's enough to buy a whole nother house. You could buy 1 house per year just from your cash flow. And when your assets are buying other assets, that is when the game has completely changed from what we're normally taught in about conventional finance, right? So that is when you see a huge shift in your investing options. Okay, so that was a little bit of a tangent, but I just wanted to convey this main point, that if you combine establishing adequate reserves with scaling a portfolio up to multiple properties, that before long, there comes a point where it becomes almost impossible to lose. as long as you are buying properties that cash flow on day one. And that's what investing in these remote areas gets us. Now, that doesn't mean that there aren't still challenges and risks with the execution of this investing methodology and actually buying these properties out of state. But these are execution risks that are a very different nature than the risks we take on when we buy an expensive property locally. I'll bet I can list off some of the risks and questions that come to mind for you. What if I invest in a bad area? What if my property manager sucks? What if my turnkey provider does a shoddy rehab or sells me a property for a price higher than it's worth? Now, these are all risks that need to be addressed, but there's a fundamental difference between these risks and the systemic risks that we take on when we invest locally. When you buy a local property, all the problems you deal with, the high prices, the high taxes, the high regulation, those are all intractable problems. There is nothing you can do to lower the prices in your market. There is nothing you can do to make the landlord laws better, right? These are systemic issues that you can do nothing about. But when you invest remotely in affordable markets, the questions you face there about finding good locations, picking good property managers, using quality turnkey providers, those problems are all solvable through research. You can learn where the good places to invest are. You can learn who the good property managers are. You can learn who the quality turnkey providers are. These are all solvable problems. And that's exactly why I created my turnkey mastery system, to help people solve these problems that have already been solved by myself and others. So now that we've busted some myths and made the case that investing in affordable out-of-state properties is actually less risky and less scary than buying an expensive property in a local area, stay tuned and watch my next video where I'm going to do a deep dive into everything you should look for as you start shopping for turnkey properties. There are a lot of turnkey properties out there, and not all turnkeys are created equal. And the next step is to dial in your search criteria so that you are looking at the top 1% of properties to buy. These are the properties that are going to maximize your chances of having consistent long-term investment performance success and having consistent long-term income. So stick around to my next video and I'm going to show you how to look for properties exactly like that.